Hi everyone, my name is Kunal Punjabi, and I'm here to give you a daily market outlook. Specifically today, we're going to be covering the 10-year government bond yields, so let's dive right into it. As you can see in this chart, the yield on the 10-year government securities in India have fallen below 6.7% in March, which is the lowest in the last 3 years. And this happens to be amid the outlook of lower interest rates in the future and measures to support liquidity both domestically and abroad. Now, the RBI, which is the Reserve Bank of India, has delivered its very first rate cut in over 4 years and lower than expected inflation in Feb, backed by the outlook for more rate cuts this year, have probably led to this. The central bank has also delivered a series of liquidity injections into commercial banks after the defense of the rupee, which actually ended up draining domestic reserves and also tightened financing conditions. In the meantime, the rupee has halted its sell off and allowed foreign investors to reconsider buying Indian bonds, reigniting foreign inflows into domestic fixed income securities, which in turn is following the inclusion in funds by DBS and JP Morgan. Finally, the rally for government securities was also magnified by support from US Treasuries after the Federal Reserve plotted projections of more rate cuts this year and slowed down the pace of quantitative easing. A current snapshot of the 10-year government bond yields, which stands at 6.629%, reflecting a change of negative 5.1 basis points. Now, the general trend over the last 2 weeks is a 15 basis points drop, which is signaling a firm bullish undertone in the bond market. What are the implications of this? The rally actually reflects heightened demand for duration, which is driven by a confluence of factors. First and foremost, softening domestic inflation, a dovish bias from the RBI, and global tailwinds from easing US yields. Now, foreign investor appetite does remain strong amid India's increasing weight in global bond indices, which is also enhancing price discovery and compressing the term premiums further, specifically the risk premiums, which tend to be higher for emerging economies, as the case in India. What is the market interpretation for this? Now, a flight to quality or duration rally is actually underway as risk adjusted return considerations tilt favorably towards the Indian sovereign debt. With the 10-year yields falling by 15 basis points over the last 2 weeks, convexity gains are being increasingly priced in, particularly across the 7 to 10-year segment that is the longer portion of the yield curve. Now, expectations of a dovish RBI have actually intensified due to declining headline and core inflation, while forward guidance has begun anchoring around growth risks, thus prompting anticipation of rate cuts in late 2025. Foreign portfolio investors have also seen some structural support, not only from passive allocation due to India's inclusion in the global bond indices, as I mentioned earlier, like JP Morgan's GBI Emerging Market Index, but also from active emerging market debt managers that are rebalancing their portfolios towards India's high real yield and fiscal prudent denominated assets. Now, the convergence of macroeconomic stability, improving twin deficits, and enhanced transparency in government borrowing programs is actually compressing the term premium and encouraging demand in the belly and the longer end of the yield curve. The belly is the 5 to 7 year segment, the longer portion is the 7 to 10 year segment. And this, in turn, is making it an attractive environment for duration extension, specifically by institutional investors and more so those who have long liability structures like insurance companies and pension funds. What is the RBI outlook? Now, let's dive deeper into this. So, first, policy reaction functions, right? The RBI stance actually aligns with the Taylor rule driven framework. For those of you who've done CFA, you'll probably know about this. They're looking to balance price stability and growth risks. So, by maintaining the repo rate at 6.5%, the central bank is actually signaling its focus on anchoring inflation expectations within the medium term target of 4%. This, in turn, will allow flexibility to respond to any growth disruptions. So, that gives them some room to play around with it. Now, the implied neutral real rate suggests a slightly dovish bias. And if inflation consistently trends below 5%, this will create room for potential rate cuts in FY26. Liquidity operations, which is the basis for the graph on the right hand side. So the RBI's liquidity absorption through variable rate reverse repo and potential market stabilization schemes reflects their efforts to align short-term money market rates with the policy corridor, thus minimizing volatility in overnight markets. Now, tightening durable liquidity surplus also stabilizes the yield curve, which in turn will enhance the transmission of policy signals. What are the market expectations? The OIS curve and swap spreads are actually pricing in 30 to 40 basis points of rate cuts over the next 12 to 18 months. That's quite significant. And this in turn reflects the market's belief in softening inflation and slowing growth as primary drivers for a dovish pivot. The 10-year government securities, which are currently yielding 6.6 to 9%, trades below the repo rate, and this in turn indicates market confidence in rate cuts, which is in turn supporting the bullish flattening of the yield curve. Some external variables to keep in mind, that is a potential Fed pivot and stability in US Treasuries, actually creates a favorable spillover effect for Indian markets, compressing the term premium on Indian government securities. But a sharp rise in crude oil or the INR depreciation, which we've witnessed over the last few weeks, could reverse these dynamics and thus necessitating a hawkish RBI stance. What are the implications for portfolio managers and what are the strategies that they can implement? So let's look at a liability-driven strategy first. Now, in a falling interest rate environment, which is what we're seeing at the moment, especially when macro indicators suggest that the RBI has likely reached their terminal policy rate, LDI strategies are highly favored. Now, insurance companies and pension funds, that is, those institutions which have longer dated liabilities, typically benefit from locking in duration and convexity at favorable levels. Some advanced portfolio insights. First and foremost, duration extension. So now, given the flattening or mild bull steepening yield curve, extending into the 10-year or the 15-year segment will provide higher price sensitivity to yield declines, and the convexity advantage becomes increasingly valuable in such an environment. Asset liability mismatch, or rather asset liability matching. Now, falling yields increase the present value of the liabilities, which is actually offset by capital gains on longer duration fixed income assets. This is particularly valuable for defined benefit pension plans and insurance general accounts. How to hedge this? As INR hedging costs for foreign institutions have actually declined due to the decrease in the forex volatility, domestic institutions can also benefit from lower expected forex such as volatility, making it easier to align the local government securities to longer dated liabilities. Some risk considerations to keep in mind. Rising crude or fiscal slippage can reprice inflation risk, thus steepening the curve and eroding any potential mark-to-market gains. And hence, a barbell structure, which is what the graph is about on the right-hand side, a barbell structure can be used to mitigate any reinvestment risk while still benefiting from duration. Some dynamic bond strategies that can be implemented. Let's look at the contextual thesis first. Dynamic bond funds actually aim to actively manage duration and their credit exposures so as to capture market opportunities in volatile rate cycles. Now, with inflation uncertainty still present and the RBI being data dependent, these funds actually provide some tactical flexibility. Now, active duration tuning. So duration in these funds typically ranges from 2 to 10 years. And in the current environment, fund managers would be moving closer towards the higher end of the yield curve, that is the 7 to 9 year segment, so as to capture convexity upside from potential RBI easing. A carry and roll down strategy. By positioning themselves in the belly of the curve, which is the 5 to 7 year segment, investors can benefit from both the carry, which is the positive yield spread over the repo, and the roll down portion, which is what happens when bonds age and migrate down the curve. They actually start to gain more and more value, incrementally higher value, specifically if the yield curve is steep. Credit spreads. Now, while the government securities actually dominate the current trade in terms of volume, some tactical reallocation towards high quality AAA rated bonds or sovereign backed instruments may provide an additional 30 to 50 basis points alpha with minimal incremental risk. So that's something worth looking into. Now, the risk considerations. These funds are actually quite sensitive to macro regime shifts, and frequent trading so as to capture any spread compression can actually increase the turnover and tracking error. So how do you deal with that? Well, you just have to actively monitor the OIS implied rate expectations and the Fed policy stance. Some yield curve arbitrage, that is intermediate to long-term strategies. Let's look at the contextual thesis first. Now, given the compression of the term premiums and the flattening bias in the curve, arbitrage opportunities do in fact exist between the intermediate portion, that is the belly of the yield curve or the 5 to 7 year segment, and the longer term of the yield curve, which is the 10 to 12 year segment, especially in steep or dislocated segments. Now, some advanced portfolio insights and some strategies that can be implemented. If inflation surprises upward, then you can implement a steepener where you sell the longer term portion of the yield curve and you buy the shorter term portion of the yield curve. Why is that? First, let's look at the bear steepness. The yield curve steepens because longer term interest rates are actually rising faster than shorter term rates, often due to expectations of higher inflation, stronger growth, or tightening monetary policy over the longer term. So, how do you position yourself? You short the longer term portion, which is the 10-year or the 30-year portion. That is, you're betting that longer term yields will actually go up, and so bond prices will go down. Or you can buy, and simultaneously, sorry, you will buy the shorter term portion of the yield curve, where you're betting that shorter term yields will go down, or at least not rise as fast as the longer term portion of the yield curve. So that's one way of implementing it. But if inflation remains benign and dovish signals persist, then you can implement a flattener trade, which is the bang opposite of what I just explained. You can also implement a box spread using OIS, where you exploit any mispricing between the bond curve and the OIS implied forward rates. Now, if OIS forwards are actually lower than the actual bond yields, then duration exposure in the physical bonds will provide alpha over any synthetic exposures. You can also implement a butterfly trade where you long the 5 year and the 10-year government securities, and you short the intermediate, that is the 7 year securities, when the 7 year is compressed abnormally. This trade profits when the curve will start to normalize or revert. Some risk considerations to keep in mind. Now, liquidity risk in off the run government securities or low volume segments could actually impact execution, that is, execution risk, or any unexpected RBI policy shifts, especially in response to food inflation or oil price shocks, could unwind the position rapidly, could force unwinding rapidly, which means you won't get the alpha that you expected. So that's my outlook on the 10-year government securities in the Indian markets. I hope you liked it. If you have any inputs or questions, you can drop that in the comment section. Thank you for listening.